Well, this is interesting. Monday, July 7th was supposed to be the day that major tariffs kicked in, but at the last moment, Trump extended the deadline by 3 weeks. And folks, this matters a lot more to your retirement than you might think that it does. I'm Van Richards. Welcome back to the Retirement Learning Lab. Now, if you've listened before we dive in, you should know the drill. Everything that we talk about today is educational only. It's not investment advice. Always talk to a qualified professional about your specific situation, and be sure to stay tuned until the end of today's broadcast for more information on the limitations of this information. So what exactly happened here? Well, Trump was supposed to let these massive tariffs kick in on July the 11th. We're talking tariffs as high as 70% on certain countries. Instead, he gave everyone 3 more weeks to figure out the trade deals. Now, on that Monday, his administration sent letters to 14 countries basically saying this: here's what your tariff rates are going to be if we can't make a deal. Now, most of these rates were similar to what that they had talked about and announced back in April, but they're saying that they're open to negotiations. But here's the thing, and this is really important for us as investors. Tariffs are different from other scary headlines. When there's wars in the Middle East, floods in Texas, wildfires in California, those are terrible events, but they don't usually hit corporate earnings directly. Tariffs, on the other hand, they absolutely can crush corporate earnings. And corporate earnings are what drive stock prices, which what drives your 401k balance. That's why back in April, when Trump first announced these tariffs, the markets went crazy. They got hammered. Then when he announced the pause, stocks bounced back. This past week, the market's reaction has been really pretty muted, which tells investors that maybe, just maybe, the final tariff rates won't be as brutal as they were when they were originally announced. Let me put this into perspective for you. If these tariffs actually do go into effect at 70%, here's what could happen to companies that are in your retirement portfolio. First, supply chains get all messed up. Think about companies like Apple. They make iPhones in China. Walmart sources tons of products from overseas, and Home Depot imports building materials from all over the world. Higher tariffs mean higher costs for these companies. Number 2, profit margins are going to get squeezed a great deal. When it costs more to make or to import products, but you can't immediately raise the prices on consumers, your profits are going to suffer. And then third, cost eventually get passed on to consumers, and that hits you and that hits me. That slows down the economic growth because people buy less stuff when everything costs more. And then fourth, all of this creates inflation pressure, which affects everything from your grocery bill to what the Federal Reserve does with interest rates, which means higher loan prices, higher credit card interest rates, higher mortgage rates. Now, here's something interesting from some research that I've been looking at from Fidelity. Market volatility has come down a lot since April. The VIX, which is an index they use to chart it, that's the fear gauge for stocks. It dropped from around 60 back in April to about 20 right now. But that could change in a heartbeat if negotiations fall apart. Let me walk you through where things actually stand with major trading partners, because the situation has changed a lot in the past week. So far, only 4 countries have actually completed deals. That's 4. The UK, China, Vietnam, and Indonesia. That's it. Out of the 200 deals that Trump proposed, we've got 4. Now let's talk about where the big problems are developing right now. You see, the European Union can be a festering problem. This went from promising to really bad, really fast. Just last Friday on July the 11th, the EU negotiators were telling reporters that they expected a big deal in the coming days. Then, over the weekend, Trump announced a 30% tariff on EU goods. The EU is now talking about taking proportionate countermeasures. That's diplomatic speak for retaliation. Now, Canada, that's another changing story that's developing really quickly. This is probably the most shocking development. Trump just announced that there was going to be a 35% tariff on our neighbors, our biggest trading partner, citing Canada's failure to stop drugs. Now, that might be appropriate, but it's going to hit the markets negatively. And that's really what we want to focus on. I don't want to talk about the politics of this thing. Let's look at the market impact. You see, his ambassador to Canada had just said days before that a deal was coming. Then they get slapped with a 35% tariff. That makes the markets go crazy. China, on the other hand, is another story. They have a separate timeline that runs through mid-August. But here's the interesting part. You see, China has been warning other countries not to make separate deals at China's expense. They're basically saying that if you get a better deal than us, we're going to retaliate against you. Japan and South Korea both are looking at 25% tariffs if they don't have deals in place by August the 1st. Auto tariffs remain a major sticking point for both countries. Now, India, that's a different story too. They basically said, we're not going to negotiate based on artificial deadlines. And they are threatening their own tariffs after the August 1st deadline. The reality? The administration has shifted from trying to negotiate real trade deals to just sending out letters with tariff rates. Now, that's a tactic, but will it work? Trump admitted that we can't meet with 200 countries, so they're taking a little bit more of a general approach with this situation. We're going to have to see how this all plays out. Let me run through a couple of scenarios that I've been thinking about. Scenario number one, and this is one that I might give a lesser probability to, maybe 10% probability of happening. That is, major trade deals get done with the European Union and other big partners. After the 30% EU tariff announcement, this seems much less likely. Frankly, the trust has been damaged in between the EU and the United States. So we'll have to see how that plays out. Now, this is scenario number two. And really, I think that there's probably maybe a 2 out of 3 to 70% chance that might come to happen. We get some deals, but the major trading partners like the European Union are going to face significant tariffs. This creates a very mixed bag for the markets with serious sector-specific impacts, and we'll talk about that in just a moment. Here's the third scenario that might happen, and this is maybe a 20% chance of happening, and that is if the EU retaliates with its own tariffs and Canada does the same, we could really see this spiral into something that's much worse than anybody could expect happening. The key thing that has changed the tone on everything is that EU negotiators went from saying that they're very close to an agreement to that they're going to impose proportionate countermeasures. That's a dramatic shift just in a matter of a few days. And here's what really concerns me. Other countries are watching this too. If Trump can announce a 30% tariff on the EU right after they have a trade deal that they thought that was going to be done, what's going to happen to the trade process with them? Now, let's talk about which sectors in your portfolio might be impacted by all of this and which ones actually might benefit, because with the latest developments, there could be some sectors that actually do benefit from all of this. The most vulnerable sectors have shifted. With 30% EU tariffs now on the table, any company with significant European exposure is at risk. Auto manufacturers could really get hit hard. We're talking about companies like Ford and GM that export to the European Union. but also European luxury brands like BMW and Mercedes that actually import a lot of vehicles to the United States. Now, consumer goods companies that rely upon European supply chains, think about everything from fashion to foods, could see their cost spike significantly. Now, technology companies that have European operations or supply chains could also face margin pressures. But here's what's really interesting, or else I think that is at least, some sectors might actually benefit more than we initially thought that they would. You see, domestic manufacturers could see a huge boost if companies are forced to reshore production. You see, energy companies, especially those that are focused on domestic production, could benefit as the focus shifts to energy independence. And defense contractors might do well as national security becomes a much larger priority. The sectors that were defensive before are now looking more attractive than they ever have in the past. Now, here's an interesting one. Utilities are mostly domestic businesses, and they might benefit. Healthcare companies get most of their revenues domestically. Consumer staple companies often have enough pricing power to pass through the higher cost. But here's a new category that I'm watching. This is companies with significant Mexico exposure. They actually might be able to benefit if production shifts from China and Europe to Mexico to avoid those tariffs. All right, let's talk just a little bit about portfolio shifting. And this is just some recommendations that I'm making to my clients. I'm not making them to you because I don't know about your specific situation. My recommendations have gotten a lot more defensive after the past week's events. To my conservative clients, I'd consider actually reducing the equity exposure maybe to 50%. 50% stocks, 50% bonds instead of the usual 60-40. Focusing more on domestic-focused companies and increasing cash positions for opportunities that might come up if the market goes backwards. And consider TIPS, that is Treasury inflation-protected securities, to hedge against the inflation that the tariffs could create. Now, if you're moderate in your risk, that game plan has shifted too. For moderate investors, I'd avoid companies with significant European exposures just for right now. Look at companies that might benefit from Mexico manufacturing. Consider commodity exposure since tariffs are actually going to drive these prices up, and maintain diversification, but tilt away from the most vulnerable sectors. Now, if you're aggressive, remember aggressive means that you could lose money. The uncertainty actually might be quite higher here. So you have to be very careful. Wait for market sell-offs to add positions. Focus on domestic winners that we've talked about, but don't try to time the bottom of the market. This situation could get much worse before it gets better. Here's my key principles that I'm looking at with clients, and you might think about these too. You see, the trust factor in these negotiations it's actually been damaged. When the European Union went from thinking that they had a deal facing 30% tariffs to the next weekend having something completely different, the entire chemistry of the situation changed a great deal. So what am I going to be watching for over the next couple of weeks? Let me give you what my checklist is, and you might want to watch these too. First, the dates becoming much more critical are going to be between July the 27th and July the 30th. This is when the European Union is likely to announce their retaliation measures. August 1st is the hard deadline. Trump has said that he won't extend it again. And the week of August the 4th will show us how the markets are really going to react to whatever is going to happen. For market indicators, I'm watching things a little bit differently now than I was 2 weeks ago too. I'm watching the VIX a lot more than I was. I'm looking for it to break above 25. That would be signaling a real concern about the August 1st deadline. I'm watching the dollar too versus the euro because currency movements will amplify tariff impacts. Rising bond yields could signal significant inflation concerns as well. And the European Union stock performance will tell us how seriously investors are taking these particular threats with tariffs. But here's a new thing that I'm watching that I really wasn't several weeks ago, and that is the trust indicators. Are other countries starting to make their backup plans? Are we seeing more deals between countries that exclude the United States? Because if the negotiation process breaks down, it could have long-term consequences that are much beyond tariffs that we're seeing right now. So here's my updated bottom line for retirement investors. The situation has gotten significantly more unpredictable after the last week's developments. What we saw in the European Union this week, that is going from very close to a deal on Friday, July the 11th, to 30% tariffs on Monday, July the 14th, shows how quickly that these negotiations can actually just fall apart. This isn't just about economics anymore. It's about whether other countries can trust the United States in negotiating in good faith. And I think that they can, but we're going to see how their trust goes going into the future. The fundamental drivers of long-term wealth building haven't changed, but the near-term risks have definitely increased. We're looking at potentially higher inflation, supply chain disruptions, and a lot of increased market volatility. Here are 3 principles that I'm keeping in mind I want to share with you. Think about these when you're thinking about your portfolio as well. Be more defensive than you normally would be because of the situation. Prepare for significantly more volatile markets between now and also in early August. And number 3, consider increasing your domestic exposure while reducing your international exposure, at least temporarily. You see, the Fidelity research that I referenced earlier suggests maintaining a balanced portfolio. And I actually still agree with that approach. But I tilt more conservative given what we've seen in the past week. The worst thing that you could do right now is to panic. But the second worst thing that you could do is ignore the situation as it escalates the risk. All right, folks, that's my take on the tariff extension and what it means for your retirement money. The key thing is this: stay informed without letting every headline drive your investment decisions. If this was helpful, hit the subscribe button and ring the bell so that you don't miss an update as the situation develops. And I'm curious, I want to ask you a question. How are you thinking about positioning your portfolio given all of the trade uncertainty that is occurring currently? Drop me your thoughts into the comments and let me know. I try to respond to every last one of them. I'm Van Richards. Thanks for watching the Retirement Learning Lab or to listening to the Retirement Learning Lab. Remember this: stay informed, stay diversified, and keep your eyes on those long-term goals.